Um, Hello, welcome everyone. My name is Dara Burns and I am the Chair of the Finance and Investment Committee. I'd like to thank you all for joining this lunchtime webinar on investing for impact with the World Bank by Naomi Cooney. Just on my general housekeeping notes, first of all, there's a Slido survey, which you can see on the title screen there. It's just 3 short questions just to be kind of completed, just to set the scene in terms of people's knowledge of the World Bank and the work it does. If you just like to complete that at any point in the next few minutes, that would be brilliant. The webinar, along with the Q&A section, is being recorded, and we hope to post to ActiveView and YouTube after the event. Participants can submit questions at any point throughout the meeting by using the Q&A portal, which should appear at the bottom of everyone's screen. Finally, once you've registered with your full name, we will have a record of your attendance. There's no need for verifiable CPD in the Society CPD scheme, but we appreciate that there may be other organisations that do require verifiability. Promoting sustainability across all practice areas is one of the strategic objectives of the Society. The World Bank is one of the most effective engines for facilitating private capital to support sustainable development. The bank provides a platform through which investors can participate in the financing of projects and programs that help countries build a sustainable future. With about $20 billion in shareholders' capital, the World Bank has borrowed over $1 trillion from capital markets to support low-cost lending for sustainable development to member countries. Naomi will talk through a number of innovative initiatives needed to successfully scale up the important work the bank does. Naomi joined the World Bank in Washington, D.C. in 2014, and currently works in the Capital Markets and Investment Department of the World Bank Treasury. She leads the design and issuance of innovative structured bond transactions that mobilize private capital to directly support sustainable development projects and help clients globally mitigate risks. She also leads catastrophe bond transactions that provide governments with insurance cover for natural disasters, such as a recent catastrophe bond transaction for the government of Chile. Prior to joining the World Bank, Naomi spent 10 years working in actuarial roles in Ireland with KPMG and Irish Life. She studied financial and actuarial mathematics in Dublin City University and became a fellow of the Society of Actuaries in 2007. She has 3 young children that love visiting their countries in Ireland. So I'd like to express an extremely warm welcome back to Naomi to address the Society, and over to you, Naomi.
Yeah, thanks, Dara. It's great to be here. I mean, as Dara said, it's about 9 years since I left Ireland. So really great to be back. I'm flicking through the participant list here to see lots of familiar names, some that I haven't seen in probably those 9 years. Others, my sister's online here, so I better do a good job because I know she's going to be reporting back to mum and dad. So yeah, it's been about 9 years, and I guess I came across the World Bank on a 45-day contract, kind of on a bit of a whim, some might say. I had no idea really what I was getting myself into. But over those 9 years, I've really realized what a privilege it is to work for an organization like the World Bank, where we really work with governments around the world, helping them with their sustainable development projects and activities. When I came across, I knew very little about the World Bank, so I want to know what you guys know about the World Bank. I've opened up the poll, so if you haven't already opened it up, scan that QR code, or you can go onto slido.com and enter 3824309. So it'd be great just to hear what you know about the bank. So yeah, thanks, Dara, for the kind introduction. If you have questions, please do ask them through the Q&A and chat, and Dara will stop me at various points to capture those. So with that, let me kick off. I mean, I think this is sort of the standard Society housekeeping. So I'm going to skip through this and let me get started. I think there's votes still coming in, but yeah, as I said, if you haven't put in your answers, let's do that. But let me kick off. I mean, when I came across to the bank, I mentioned this, I knew very little. Good to know that my job seems to be a bit safe for now, because most of you on here say you have basic knowledge. Some know nothing at all about the bank. So I hope this is going to be an interesting session for you all. So about 3/4 of you have little knowledge and the other quarter know nothing. And then one person says they're an expert. It wasn't me. So whoever that is, I hope you're not going to come and steal my job. How familiar are you with World Bank bonds? Again, 2/3 of you say you know nothing. Oh wow, 2/3 of you say you know nothing. So this is going to be great. A third of you know a little. This is not intended to be a sales pitch this session, but if you come away intrigued about World Bank bonds or wanting to know more, I mean, this is all about investing with impact. And certainly if that's what you want to do, the World Bank is a great place to start. So I hope you learn something about World Bank bonds. And then catastrophe bonds. I mean, this is really the area of work that brought me to the World Bank. It's probably the closest to sort of the core actuarial skills. I spent close to 10 years working in life insurance, and I transferred that skill set and knowledge that I gathered in KPMG and Irish Life, and started in the unknown area to me of catastrophe insurance. So I hope some of you, oh, that's good. Some more of you know a good bit about catastrophe bonds. So maybe there are some investors in catastrophe bonds, or some of you in your insurance companies use catastrophe bonds to transfer some of your risk. So we'll touch on sort of the World Bank's role in the catastrophe bond space. So with that, let me start in, I mean, I'm going to structure this presentation probably in 3 sections. The first section is really around what is the World Bank? Who are we? What do we do? How did the World Bank originate? So a little bit of a history lesson. Some of this I didn't know when I joined the bank. Some of it I've been sort of catching up on for this session. Then in the second part of the session, I'll talk about sort of the innovative outcome bonds, which is the area that I'm sort of focused on at the moment, where I work in World Bank Treasury, where really we are using very unique structured bond transactions to mobilize capital for very specific development projects that might otherwise not have access to capital markets, or that might want to transfer risk to private investors. And then I'm going to talk about catastrophe bonds in the last section. So hopefully there's something there for everybody, something to interest you. And as I said, do ask questions. No question is too silly. So what is the World Bank? I mean, we're an international organization owned by 189 member countries, including Ireland. Our purpose is to end extreme poverty and promote shared prosperity. We added on a livable planet recently. And the goals of the World Bank are really aligned with the UN Sustainable Development Goals. Everything that we do, all of the projects and activities that we support are aligned with the UN Sustainable Development Goals. We are the largest source of development finance and expertise. We've about 75 years experience of financing development projects across the world. This figure might be a little bit out of date, but about 240 billion in loans outstanding across 77 countries. So really huge exposure and to countries and projects around the world. And to do that, we have 12,000 staff in 136 offices, with the headquarters in Washington, DC, where I am. The transactions that I'm going to talk about today are issued by the International Bank for Reconstruction and Development, which is the most well-known probably part of the World Bank in the capital markets. It's a AAA rated entity, and that AAA rating is based on our capital base, our reserves, and our prudent financial policies. So that's a little introduction. Then how did the World Bank come about? I mean, the World Bank was created in the aftermath of World War II, really to help with reconstruction of Europe in the aftermath of the war. Very soon, so this was the creation of the International Bank for Reconstruction and Development, and very soon it became commonly known as the World Bank, and it is commonly known as the World Bank in the capital markets, although the World Bank Group includes a number of other entities, which I'll touch on later. It was designed to be self-financing, where it would earn income from its activities to support those activities. So how it does that is it goes and the World Bank borrows from the capital markets through the issuance of bonds, using sort of its initial paid up and callable shared capital. And then it uses that to lend to countries at rates that are effectively cheaper than what they would be able to borrow directly from the market themselves to help finance those activities. As I said, it was initially to help rebuild Europe. The very first loan was to France, and that was a 250 million euro loan back then, a huge amount to help with reconstruction in Europe. And since then, I guess in the 1960s, the bank's focus shifted towards poverty alleviation, continuing to lend to countries that were creditworthy. So the World Bank, IBRD, lends to middle-income countries. Currently, our key exposures are to India, Indonesia, Brazil, China, Mexico, Colombia, and then a whole host of other middle-income countries. We've been in the capital markets for about 70 years, so issuing sustainable development bonds for over 70 years. So huge history, experience, and track record in the capital markets. Ireland has a role in all of this. We joined the World Bank as a member in 1957. We've continued to be a member since then. Our membership, we have about $1 billion, just short of $1 billion of capital the Irish government commits to the World Bank. Part of that is paid in and part of it is callable in the event that it's needed to be called on, which has never been needed. And that gives Ireland about 0.34% of the voting power within the World Bank. So the key or the main shareholder is the US, followed by other big shareholders are Japan, China, Germany, the UK, and France. So each with their own sort of their voting power based on the amount of shares that they, or the amount of capital that they've committed to the World Bank. What I thought might be interesting would be to pull out some of the information about Ireland's sort of role or experience with with the bank. I mean, historically, Ireland was actually, one of these developing countries, and it was a bit of a history lesson for me when I was preparing for this session to go back and look at those projects where Ireland did actually borrow from the bank. This was back in the 70s. Ireland actually had 8 different projects that the Irish government got loans from the World Bank to help finance certain activities. There's a whole host of information. I mean, the World Bank, because it's I guess publicly owned, all of this information is public. So if you're interested in knowing the economic history of Ireland in the 70s, there's some very interesting project documents that you can go and read up about, and they're all online. Those 8 projects, there was a 30 million project. Some of you might remember from the 70s or 80s, the Industrial Credit Company. It was Irish government owned before it was bought by Bank of Scotland in 2001. But they took a $30 million loan to support they couldn't borrow from the capital markets, and they wanted to support industrial development. So to allow them to expand their lending to industries within Ireland. There was other interesting projects around education and schools. Obviously, Ireland had a huge focus on increasing the education in Ireland in the 70s to build a more educated workforce. And there was a focus on having a workforce that was highly technical skilled. So there was, some of you online may have sat in some of the schools that were funded by the World Bank. I mean, I took a quick scan. There was schools from, Ballyfermot and Ballymun to in Cork and Kerry. The Limerick, the National Institute of Higher Education in Limerick received funding from the World Bank. Athlone Institute of Technology received funding from the World Bank. And then there was also projects in sort of power plant projects. Anybody from Kerry online, the thermal units at Tarbert in Kerry, I believe, were financed by a project that was financed by the World Bank for the ESB back again in the 70s. Some things don't change. I believe some of these projects overran and were behind schedule, so some things don't change. But good to see that the bank, that Ireland has experience, and that we came out of that, right? So we stopped borrowing. Ireland no longer needed to borrow from the World Bank, and they repaid all of their loans back in the early 80s. Other interesting pieces about Ireland, I mean, where I sit in World Bank Treasury, we listed a huge bond. It was a $1.9 billion Euro bond on the Dublin Stock Exchange in 2019, and that was to highlight sustainable development, as Ireland was becoming a sustainable development hub, or a hub for sustainable development finance. And we continue to look to Ireland both for investors. So a lot of our investors, we certainly have some investors who are based in Ireland, and we look sometimes to issue bonds in Ireland. So I mentioned that the World Bank, as it's known in the capital markets, really refers to the International Bank for Reconstruction and Development. It provides loans to governments of middle-income countries. There also are 4 other entities within the World Bank Group. There's the International Development Association, which provides loans and grants to governments of lower income countries. So that is mainly financed through shareholder capital and capital increases to support grants and concessional lendings to sort of the lowest income countries. It does borrow from the capital markets, but on a much smaller scale than IBRD does. The International Finance Corporation is the entity of the bank that provides lending to private sector enterprises in developing countries. That's the IFC, and they also issue bonds in the capital markets. And all 3 of these entities are rated AAA, all with similar goals, but separate legal entities. So all with their own risk profile and capital structures. Then there's MIGA, which provides political risk insurance to investors and lenders to allow them to really, it promotes providing this political risk insurance, promotes sort of foreign direct investment into developing countries. And then finally, there's a smaller entity that's around the settlement of investment disputes with an international context. Where I sit in World Bank Treasury, we are the Treasury for the IBRD and the IDA. So I guess as Dara mentioned, I mean, the World Bank really is a hugely effective engine for facilitating private capital and to support sustainable development activities in middle income and low income countries. We've done this through, I mean, the bank has about 20 billion of paid in capital. And with that paid in capital since 1947, we've been able to turn that around and leverage international bond markets, mobilizing about 1 trillion of private capital to finance sustainable development projects globally. So really just a huge, huge engine for mobilizing private capital that might otherwise not be able to invest in emerging markets. We provide investors with a way of doing so through the very safe environment of a World Bank AAA rated bond. All of our bonds that we issue are labeled sustainable development bonds, and we issue an annual impact report that covers the entire portfolio of projects for the fiscal year. I mean, to give you some idea of our funding program and the projects that we look at and we cover, the bank in our last fiscal year in 2022, we issued about 41 billion of bonds. That allowed us to finance or support 680 projects. 35 million people were covered by social safety net programs for those projects. 17 million people were provided with access to health, nutrition, and other services. 7 million people had access to improved water because of those projects. I mean, and a key area of focus for the bank right now is obviously on climate finance. And 38% of that financing was going directly towards climate finance, with 50% of that for climate adaptation. And that is leading to about 8.5 million of CO2 emission reductions annually from those projects. So huge, huge sort of broad portfolio of projects that the bank supports through all of this private capital. As I said, everything that the bank issues is a sustainable development bond, and that is aligned with the goals of the World Bank. The first bond we issued was in 1947, and that bond was 6 times oversubscribed. And since that, we are very successful in the capital markets. Last year, we issued bonds in 20 different currencies with a range of maturities. Our fiscal year runs from July to the end of June every year. So far this year, so since the 1st of July, we've issued about 14 billion of bonds in the capital markets. So huge engine and huge track record and experience. Our goal, of course, is not only to raise funds at the most reasonable cost for our clients, but also to develop innovative solutions for some of the most difficult development challenges. We, because we are have such an experience and track record in the capital markets, that allows us to do sort of innovative things. We were the first issuer of the green bond in 2008, and of course, many of you might know that that green bond market has grown to be about a 2 trillion size market since 2008. In 2017, we issued the world's first pandemic bond, so in the catastrophe bond space, but a bond that would transfer the risk of a pandemic occurring to capital markets investors. We continue to innovate, and some of those latest innovations are in the outcome bond space, and that's where I'm going to talk about some transactions that we have done recently and that are really around mobilizing funds to directly support projects that might otherwise not have access to capital markets. So let me switch gear and start talking about sort of those outcome bonds. I mean, and this is the area that I in particular work in. I work in a structured finance team within the World Bank Treasury. We sit very much alongside the core funding team that issues all of these core benchmark bonds that are plain vanilla bonds where the proceeds are being used to support the overall projects and activities of the World Bank. I sit very much alongside this team, so I'm not going to talk any more about those sort of plain vanilla bonds and our overall program. I'm going to talk particularly about some projects that we have been looking at recently, where we've been working on this new sort of structured bond that we call an outcome bond that we are now looking to replicate and scale up to support other projects. How these came about is there are projects that often have financing challenges that we're trying to come up with a capital market solution to be able to support those projects. For instance, there are projects out there, lots of projects in the climate space that are really aimed to either reduce carbon emissions or remove carbon emissions, and they have a future revenue stream from the carbon credits that they expect to generate from their activities in the future. But what they don't have is the upfront financing that they need to get off the ground and to allow them to implement their activities that will ultimately generate those carbon emission reductions. So we wanted to come up with a structure that would allow us to generate those upfront financing for those projects through a World Bank bond. Another project that we supported was around a project that had a donor willing to support the project, but only if the project was successful. So based on sort of the donor would pay for project success, but the project didn't have the funding that it needed to actually be able to deliver those successful outcomes. So again, we developed a World Bank bond structure that would allow us to do that. And then thirdly, we did this transaction for UNICEF, where UNICEF, when COVID happened, needed to very quickly mobilize funds. And they didn't have access to capital markets. They're not able to borrow. It's against the UN Charter for them to borrow. So we again developed a World Bank bond structure that allowed us to mobilize capital for UNICEF. I'm going to take a little pause and I'm going to play a video that talks a little bit more about these outcome bonds and what we've been doing before I sort of go into the details of each of the three transactions. And after that, I'll take some questions and then we'll go to the catastrophe bond sort of segment. So hopefully this video plays. Dara can stop me if it doesn't.
Today's development challenges require urgent action. From eliminating poverty, reducing carbon emissions, and creating jobs, to saving endangered species and conserving biodiversity. Development financing needs are much greater than what the world's development banks, philanthropists, and donor countries can provide. Global capital markets have plenty of financial capacity. But how can we mobilize those resources for development projects? Private investors are increasingly focused on environmental and social outcomes. And many impact-focused investors seek ways to directly support development projects and participate in outcome risks. World Bank outcome bonds bridge the interests of outcome-focused investors and development projects. The transactions mobilize private capital to solve the timing mismatch between financing needs for project implementation and potential future revenue. Outcome bonds can allow for efficient use of funds from donors who prefer to pay for successful development outcomes. Financing a project with future carbon credit sales revenue? Done. A World Bank outcome bond mobilized upfront capital for a water purification project in Vietnam that will generate carbon credits from the use of water purifiers, replacing the need to burn wood to boil water in schools and other institutions. Transferring conservation project risk from donors to investors? Done. a World Bank outcome bond mobilized upfront capital for a project in South Africa that aims to grow the black rhino population and supports job creation in the local economy. Does your project need upfront or additional financing today? Is an entity or donor seeking to pay for successful development outcomes rather than for project activities? Impact-oriented investors are looking for opportunities to align investments with positive development outcomes. The World Bank leverages its bond infrastructure and capital market expertise to bring together project developers, bond investors, and donors to mobilize capital to directly support projects, optimally allocating funds for development outcomes. Independent monitoring and verification of outcomes ensure all parties have confidence in reported outcomes. Whatever your environmental or social goals, the World Bank Treasury can search for a financial structure to meet your project needs. Visit treasury.worldbank.org to.
So I hope that plays okay. I presume it did. Dara would have stopped me otherwise. I mean, as I said at the start, it is a real privilege to work at the World Bank. I get to work on these amazing projects around the world. Little did I know that this project, I'd be working on a project that would take me to Vietnam, where actually I visited while I worked at KPMG. It's an amazing country. And I was delighted to have the opportunity to go back there last year to work on this project. We have found that there are a lot of projects out there that really are aiming to do activities that will reduce or remove carbon emissions, but a lot of them really struggle to generate the financing that they need to get off the ground. And as I said, we are in the space where I sit of trying to come up with innovative solutions to help them to do that. And that's exactly what this bond that we issued in February this year aims to do. And I mean, we really hope that it is a template for other projects, not just for the World Bank to issue bonds to support, but maybe other entities can replicate this structure to support projects that are really good projects that struggle to get financing, where maybe investors don't want to directly invest in the project, don't want to take the project risk, but really are worthwhile projects. This was a project in Vietnam where the project developer aimed to manufacture and distribute water purifiers to rural schools in Vietnam. I've just had a drink of water while the video was playing. We all take for granted that we have access to clean water. These were schools in rural Vietnam that had to collect wood and biomass and burn it to be able to provide clean water to the children in the schools. And with these very simple plastic water purifier devices that you see here, that with access to these, the schools would no longer need to collect that wood and burn it. And that in itself reduces carbon emissions, right? So these schools would have access to clean water. They also would have cleaner air because they're no longer burning wood, and that obviously reduces carbon emissions. The project aimed to manufacture and distribute 300,000 water purifiers to 8,000 schools in Vietnam. So providing clean water to about 2 million school children in Vietnam, and through the process reduced carbon emissions by about 6 million tons over the 10 years of the projects. So as well as having this very climate friendly benefit, the project also had really nice social co-benefits where it was providing clean water, clean air. There was no longer ordinarily, it would have been women and children who were collecting the wood. They no longer would have to do that. So a really great project. The project developer was aiming to distribute these for free to all of the schools with the support of the government of Vietnam. So the government of Vietnam was selecting the schools that would be provided with these water purifiers and was working with this project developer to distribute them. This project came to us actually from Citibank, who were looking to buy the credits from the project. So this project developer had a good track record and history. They had implemented other projects that had generated carbon credits, and Citi was looking to support the project by being the off-taker of those carbon credits. We call them off-takers. So they would agree to buy those carbon credits in the future at a certain price. So the project developer knew that they had this revenue stream where they had Citibank who was going to come in and buy those carbon credits in the future. But what they didn't have was the upfront financing that they needed to actually allow them to get that project off the ground, to start the manufacturing and the implementation of it. So that's where we came in with our sort of bond that we called the Emission Reduction Linked Bond. That bond, it was a $50 million bond that we issued in February of this year. And let me talk through the structure of the bond and the transaction and what it looks like and how it was able to sort of generate financing for this project. And this is sort of the diagram on the left, which I'll try and talk through. I mean, the project needed 7 million of financing. So you might say, okay, it's a $50 million bond. Where does the 7 million come in? So we issued a $50 million bond. It's a principal protected bond. What that means is the 50 million proceeds stay with the World Bank. So we don't pass any of that 50 million to the project. That 50 million stays with the World Bank. It supports our overall sustainable development pool of activities and projects across the globe, which I talked about earlier. You know, that sort of $40 to $80 billion funding program that we have any year. This bond, the proceeds of it, support sort of our overall sustainable development activities. So investors who are buying this bond are buying a AAA rated principal protected bond. Now, the unique feature of this bond compared to other World Bank bonds is that we got investors to agree to give up a regular World Bank coupon. So the coupons that they would ordinarily earn on our regular plain vanilla bonds, investors agreed to give up those, and for us instead to pass those foregone coupon payments to the project developer through Citibank, right? So we use Citibank as a vehicle between us and the project developer, where we pass those foregone coupon payments to the project developer. I mentioned 7 million. They were the financing needs of the project. So we sized the bond, so the 50 million, based on the needs of the project. So what was the size of the bond in the interest rate environment in February that we needed to issue in order to generate that 7 million of coupon flows that would go to the project? Ordinarily, we would pay coupons on World Bank bonds. We pay them on a monthly basis to investors. What we did here is in order to sort of pass that 7 million to the project, because the project developer needed a lot of that financing upfront to actually finance all of the manufacturing and distribution. So no good passing that financing at this was a 5-year bond. So we wanted to upfront the financing rather than passing, it across the duration of the bond. So we entered into an interest rate swap with Citi, where we pay Citi on our end, we pay them our regular funding costs like we would on any other World Bank bond on their side of the swap. And then on Citi's side of the swap, they pay the upfront, the 7 million financing that goes to the project. And that amount gets passed to the project developer through another agreement. In return for getting that 7 million of upfront financing from our bond transaction, the project developer agrees to give up a portion of their future carbon credit revenue from the project. So again, I mentioned Citibank was going to be buying these carbon credits. They had entered into a purchase agreement with the project developer, where they were agreeing to buy a certain proportion of those carbon credits in the future at a fixed price. So we took a portion of those and said, okay, what amount of financing do we need to be able to provide investors with a return for giving up sort of their regular guaranteed World Bank coupon? So the project developer gave up about 30% of their carbon credit revenue, which amounted to about 10 million. So for receiving 7 million upfront, the project developer is giving up potentially 10 million in revenue from this project, from the carbon credits it would generate. That left them with 70% of the carbon credits that they could still, sell either to Citibank or to other entities in the carbon market in the future. So there certainly was an incentive there for the project developer to be successful with the project. Now, who takes the risks in the project? I mean, Citibank is taking the carbon price risk. They're agreeing upfront that they will buy these carbon credits at a certain fixed price in the future. The investors who were buying this bond were institutional investors who not necessarily, wanted to support these types of projects, but didn't want to take carbon price risk. So what the investors are taking is they're taking the project risk. So they're saying we'll give up our regular World Bank coupon for the potential to earn this coupon linked to the performance of the project. So if the project doesn't develop as expected and doesn't deliver the outcomes as expected, that's why we call them outcome bonds, then the bond investors would not receive the return that they're expecting. So for investors, what that looks like, investors in this bond, I mean, they're guaranteed a return of principal at maturity. So as I said, the $50 million stays with the World Bank. And so they're guaranteed the return of that 50 million at maturity. They're also provided with actually a small minimum guaranteed return. We actually issued the bond slightly below par, which provided them with about 0.5% guaranteed minimum return over the 5 years. And then if the project is successful, if it delivers and distributes all of these water purifiers as expected and generates the carbon emissions as expected, the project, actually, I didn't say it's going to be registered. It is now registered on Vera, which is one of the most well-known and established carbon registries in the carbon market. And the carbon emissions will be verified by Vera, so an independent sort of auditors will verify those carbon emissions. So if it does all that as expected, the investors in this bond can potentially earn a yield of about 5%. That yield is about 1%, so about 5% per annum. It equates to. That's about 1% higher than what they would ordinarily earn on a regular World Bank plain vanilla bond. So what this does is it gives investors the opportunity to directly invest in projects in emerging markets. They can say, these investors can say that my $1 is going to finance that project in Vietnam that's producing and generating these water purifiers, which isn't the case for all World Bank bonds, right? With our regular World Bank bonds, you're supporting a whole host of projects and activities around the world. We think this, or we believe certainly that this structure is a win-win for everybody. I mean, the investors, as I said, it's a very safe way for them to invest in projects in developing countries because they are guaranteed the return of principal, they're guaranteed a minimum return, they potentially earn a yield pickup compared to regular World Bank bonds. So compared to, they're buying a AAA rated bond, but with the potential to earn a higher than AAA rated return. For the project developer, it generates this financing that they otherwise wouldn't have access to. They don't have access to capital markets. It's difficult for them to raise financing, to find investors who want to directly take the project risk. For the schools, they're provided with the water purifiers for free. They're getting clean water and clean air because of it. And the bank, I mean, for us, these transactions, they allow us to support particular projects, but they also raise funding for our broader program and for society as a whole, right? We're all benefiting from the reduction in carbon emissions. So we really think that this bond structure is a template that we can use to finance other climate friendly projects that have a potential future revenue stream from carbon credits, where we can use a structure like this to securitize a portion of that future carbon revenue and allow us to pass the project risk from these project developers to private investors. Because ultimately, if for whatever reason the project isn't successful, there's no obligation on this project developer to repay that 7 million. That is not a loan. It's a financing contingent and the repayment contingent on the success of the project. So hugely successful project, and we hope that there'll be more of them to come. The second transaction I want to talk about is this rhino bond, and you saw some nice rhinos in the video. This project came about during, I guess we started working on it during COVID. There were these parks in South Africa that have been very successful at conservation activities for the black rhino. The black rhino is an endangered species in South Africa. I learned a lot about the black rhino through this project. Hopefully someday I'll get to go and see them in South Africa. We weren't able to travel there because of COVID. But these parks were very successful in their conservation activities. But during COVID, they had a fall in their revenue, both from the government, because the government needing to respond to COVID, and also tourism obviously fell completely. So no revenue to support the continuation of their activities. So they really lacked the financing that they needed to be able to continue those activities and maintain all of the success that they were having in the parks. And I must say as well, the black rhino is sort of known to be an umbrella species in these parks in South Africa. If you help conserve the rhino, you also protect other fauna and species that grow in those parks. This project had a donor who wanted to support the project, but they wanted to support them with this Pace for Success grant. So they didn't want to just give a grant straight up front. They would support the project if the project could demonstrate that it had been successful. So they wanted to pass that project risk to somebody else and only pay on success of the project. So again, we used a World Bank bond structure to do that, to mobilize the upfront financing that the project needed in order to be able to generate those successful outcomes, and do that with the support of sort of this outcome payment from this donor. So again, very similar structure to the Vietnam carbon bond, where we issued a principal protected World Bank bond. In this case, it was a lower interest rate environment, right? Interest rates they'd started to rise, but not quite to where they are today. So the project needed about 10 million of financing. And back in last March last year, when we issued a bond, to be able to generate that 10 million of financing through investors' foregone coupons, that meant we needed to issue a bond that was $150 million in size. And so we issued a $150 million bond. It was a 5-year bond again. The project expected to be able to achieve the outcomes it set out to do over a 5-year period. And so the 5-year bond was set to match the 5-year project period. Again, those $150 million stay with the World Bank. They finance our regular World Bank projects and activities. And again, here investors agree to give up a regular World Bank coupon, and instead for us to pass those foregone coupon payments to these parks in South Africa to fund their conservation activities. And that included, putting in new water holes, hiring new rangers, and putting in new fencing in the parks. So lots of activities that investors, would you believe, really got stuck into the details of understanding what the funds were being used for, in order to generate the successful outcomes that they wanted to do. In return, the project developer agreed to give up that grant that they would have, that they were providing from the Global Environment Facility. And that grant would be used then to provide this outcome payment to investors who were ultimately taking the project risk. I mean, one might find it very difficult to believe that you could find a financial instrument out there where your return is based on the growth rate of the rhino population, but that's exactly what this transaction does. The investors in this case, their return depends on the outcome of this project, which ultimately is measured based on the growth rate of the rhino population in these 2 parks in South Africa across the 5-year period. There's an independent calculation agent who is an expert in counting rhinos. And then there's a verification agent who verifies those numbers. And ultimately, at the end of the 5 years, the investors will get a return based on that growth rate. Growth rate for this project was seen, or successful growth was seen to be a 4% growth rate. So if the rhino population grows by 4% over the 5 years, the investors can stand to earn a return of about 3%, which at the time, again, this was in a lower interest rate environment back in last year. That was about a 50 basis point pickup compared to a regular World Bank bond. And the investors who are buying these kind of bonds are really institutional investors. I can say some of their names because these were publicly disclosed in our press releases. Institutional investors like Nuveen and Mackenzie. We had Believe pension fund, the Danish pension fund, bought the Emission Reduction Linked Bond. IKEA out of Dublin actually purchased the Rhino bond. So yeah, very much institutional investors, but who have a focus on sustainable development activities and are able to want to invest in projects like these, but sometimes find it difficult to do so. So these kind of structures allow investors or provide investors with a very safe environment to do so. And then the last sort of outcome bond that I'll touch on, and then I'll pause. I see there's a few questions. I'll pause to talk about them, was for UNICEF. This was a little bit of a different structure. UNICEF in 2020, obviously, again, needed to ramp up its activities. to support its response to COVID in all of the countries that it supported. They wanted to launch a big fundraising campaign. And to do that, they needed about 50 million for that sort of fundraising and marketing activities. And they, based on their track record, experience and history, they knew that if they could, if they had this 50 million to spend on this fundraising campaign, that would generate, about 500 million in donations. But they didn't have that funding that they needed to be able to start that fundraising effort. They're not able to borrow from the capital markets. It's against the UN Charter to borrow. So we worked with them to come up with a structure where we would issue a World Bank bond and pass some of the proceeds of that bond directly to UNICEF to support its activity. And the repayment of that would be dependent on their fundraising efforts in 18 target countries. So a little bit of a different structure here, where we issued this under our Capital at Risk Notes program, or actually we do pass some of the proceeds directly to UNICEF in this case. So again, it was a $100 million bond. 50 million of it went directly to UNICEF to support that fundraising activity, and the other 50 million again stays with the World Bank to support our overall sustainable development activities. And as I said, that 50 million from UNICEF's portion was repayable based on the fundraising activities of UNICEF. So the bond investors were taking direct exposure to UNICEF in this case. Let me take a pause there, Dara, maybe for 5-10 minutes, take some questions before I sort of move into the second part of this, which is on catastrophe bonds.
No, that's no problem. Thank you very much. So far, Naomi, it's been extremely interesting. A number of questions have come through from people. Initially from Aaron Kilboy, obviously, the World Bank exists for a long number of years, since World War II, but ESG is a more recent development. But has the increased focus on ESG in recent years been a big driver of increased demand for the World Bank's bonds?
Yeah, I mean, it has. I mean, we have been, as I said, in the capital markets for a very long time, so a huge track record and experience. But yeah, I mean, we were the first issuer of green bonds, and since then that has grown. Everything we do, every bond we issue is labeled a sustainable development bond with a small separate portfolio of green bonds, and there is huge demand. Most of those bonds, even our benchmark bonds that are huge transactions into the billions, are generally oversubscribed, and we're just seeing an increasing interest from investors to put their money into these sustainable development activities. But we're also seeing interest from investors who want actually this direct exposure to projects. So when we did the sort of UNICEF bond and the wildlife conservation bond, it wasn't an easy task to get investors to invest directly into a project that was ultimately their return would be dependent on this rhino growth rate, and where the risks that they were exposed on the return was really poaching in these parks in South Africa. But we have gotten investors very comfortable with the structure that we've used, where it's principal protected, where investors earn some minimum return with the potential to earn an upside if the project is successful. The carbon bond then had increasing interest on the back of that rhino bond, and we're seeing more and more investors who really are interested in these sort of outcome bonds where they can get direct exposure to these really valuable and worthwhile projects.
Okay, thank you. And do investors, a question from Tom Barry, are investors doing it for the returns available, or is it to achieve a ESG sustainability goal within their own company?
Yeah, great question. And we get this all the time. I mean, particularly we get it also internally in the bank, where, people in the bank might think, oh, well, these investors should give up their return, completely because these are worthwhile projects. I mean, these bonds that we're issuing, we're not issuing them to philanthropists or to donors. We are issuing them to investors who have return objectives and requirements that they are trying to meet. So definitely they are doing them with generating a return in mind. That being said, they are also investors who are interested in ESG, who are interested in sustainable development, and also who have a real focus on knowing what their money is directly supporting. And that is what these outcome bonds are allowing investors to do, to really show that actually I'm supporting this particular project. I can say that my dollar supported this activity and this project. So it's both, right? It's investors who have an ESG focus, but also who want to earn a return. And again, we think these are a really nice structure, because not only do you get that sustainable development, I mean, there's sort of two sustainable development angles to the bond. Your proceeds are supporting the overall sustainable development activities, and then your coupon or your foregone coupons are supporting a very particular project. And you have this AAA rated, principal rated bond. We actually got these rated by S&P, where there's a rating some of you mightn't be familiar with called, it's a AAA small p, where the principal is rated AAA, and where you can, and then the return obviously is subject to the individual project risks, but where you can earn a return that's higher than a normal World Bank AAA return.
Okay, thanks. Neve Crowley has asked, how long would it typically take for a project to be approved for funding?
Great question, Neve. It's a long time since I saw you, Neve, so nice to see you online. I mean, the Rhino bond was a long time. I won't even begin to tell you how long that project took to sort of to come to market. The carbon bond was much quicker, right? We started working on it in September, October, probably October last year. We were in London meeting with Citibank, and they brought this idea to us, and we issued it then in February. So that was about 6 months, and they are longer, right, than our funding team that we sit next to. I mean, they're issuing bonds on a daily basis, much quicker, nowhere near the lead time. But these are very unique transactions. So for investors to get comfortable with the projects, for us to make sure all of the economics of a transaction makes sense for everybody involved, that takes time. So about 5 to 6 months the Vietnam took. We hope some of these other transactions that we're working on now will have a smaller lead time, and as we do more and more of these, we hope that time will sort of be reduced, but definitely longer than our plain vanilla bonds.
Okay. I think that the last question on outcome bonds then, does the fact that the bond issuance is usually greater than the financing required for the particular project in question essentially mean that the structure of the outcome bond requires more capital overall than a plain vanilla bond issue?
No, right. So the bank, in terms of, I think this question, I maybe have it wrong, is relating to the. Okay, let me go on 2 tracks then, and they can come back if I haven't answered this properly. So when we do these bonds, the 50 million is just like any other World Bank bond, the proceeds. For us, we are not taking any additional World Bank risk by doing these transactions, right? We pass, in the Vietnam case, we pass the Citibank has taken the carbon price risk, and we pass all of the project risk to the private bond investors. So no additional risk for the World Bank in these. So we don't need to, there's no extra capital requirement for us for us to have to issue these bonds. If the project isn't successful, we don't pay investors a return. So their return is completely dependent on the performance of the project. So I hope that maybe answers the question. Maybe if I haven't got it right, they can let me know.
I think perhaps the question was the fact that exposing you need 7 million for a project, but 50 plus 7 has been raised. Does it mean that you have to raise like a multiple of the amount that you're
No. So the 7 million comes directly, again, maybe just to talk through it. So the investors in these cases, in the Rhino bond and the carbon bond, they're agreeing to give up their regular World Bank coupon. What we do is we enter into an interest rate swap, and we effectively use that interest rate swap to pass the present value of those foregone coupon payments. So what we would have paid in regular World Bank coupons if it was a plain bond to investors, we take that, we package it, and we pass it to the project. So that 7 million is just coming from those foregone coupon payments, and then the investor's return is coming from either the carbon revenue that the project developer would generate, or in the case of the Rhino bond, from the donor's outcome payment.
Okay, I think that's how it should be looked at. Like it's a variation of a vanilla bond as opposed to a entirely. Okay, exactly. I think that's all the questions around outcome bonds then. So maybe.
Okay. Okay, great. Let me move on. So catastrophe bonds. I mean, I think this is going to be closer to maybe some of what you do. I think if I remember rightly, some people said they were very familiar with catastrophe bonds. I have to admit, again, when I joined the bank, I knew very little about catastrophe bonds. I was working in life insurance from my Irish Life days and my KPMG days, but thankfully we are can use our actuarial skill set in a whole host of different fields, and our skills are definitely transferable. And this is how I sort of came to work at the World Bank. It was in the catastrophe insurance space. The bank has a long history of supporting developing countries with their disaster risk management plans. And that includes helping governments have financing in place ahead of a disaster occurring, which ultimately allows them to respond quicker and to finance their immediate emergency relief and recovery efforts if a disaster happens. One of the tools that the bank uses to do that is catastrophe bonds. And we use these, or governments use them to pass the risk from some of the most sort of extreme catastrophe events to pass some of that risk to insurance and capital markets. I'll play another short video to give me a chance to take a drink of water that will sort of introduce you to the catastrophe bond transactions that we've been doing. And then I'll talk you through sort of the World Bank's role in the catastrophe bond market and a recent transaction that we did for Chile. And then hopefully we'll have some time for some more questions after that.
Natural disasters are becoming more extreme and costlier. They disrupt lives and livelihoods and reverse economic and development gains. Countries need to increase resilience against these disasters to protect both their physical assets and finances. Financial resilience is the ability to withstand financial challenges or disruptions. Countries can build financial resilience with savings and pre-arranged borrowing. And for the most severe disasters, countries can transfer these risks to insurance and capital markets. A catastrophe bond, known as a cat bond, is a capital market instrument that allows entities to transfer disaster risk to bond investors. The World Bank has a unique experience in issuing cat bonds that provide coverage to its member countries. Several governments have received coverage from the World Bank. They pay a fixed premium and receive a payout if a covered event occurs. The World Bank packages the catastrophe risk into a cat bond, placing the risk with bond investors. Importantly, these cat bonds are not debt obligations for clients. Cat bonds are purchased by specialized investors who understand catastrophe risk. These risks are largely uncorrelated with other market risks, and that allows investors to diversify their asset portfolios. Investors are very supportive of World Bank cat bonds because they cover diversifying risks in emerging markets where investors do not already have exposure, and because the World Bank is a respected and repeated issuer in the cat bond market. When investors buy World Bank cat bonds, the proceeds are used for the World Bank's sustainable development lending activities until the World Bank either makes a payout to its clients or returns the funds to investors when the bonds mature. Cat bonds offer clients quick payouts by relying on an event's physical parameters rather than waiting for actual assessments of damages and costs. The World Bank has issued parametric cat bonds covering hurricane, earthquake, tsunami, and pandemic risks. For example, Mexico received a $150 million payout in 2017 when a magnitude 8.1 earthquake hit the Chiapas region. Why should countries consider a cat bond transaction with the World Bank? The World Bank mobilizes the risk-bearing capacity of global capital markets to cover catastrophe risks. Cat bond transactions demonstrate good management of disaster risk to the market. Countries will be insured by a AAA-rated institution of which they are a member. They will benefit from the experience and reputation of the World Bank, which has been in the cat bond market since 2009, issuing many successful and innovative cat bonds for member governments. The World Bank will facilitate all the external service providers required for a cat bond transaction and manage the entire transaction process, supporting clients throughout the process. A cat bond can be a useful instrument in helping protect countries exposed to natural disasters. Interested to learn more?
Okay, so cat bonds. I mean, the cat bond market. Some of you are familiar with, some of you said you're not. So let me just give a quick overview of the market itself. Today, I mean, the market stands at about 42 billion. So 42 billion of catastrophe risk is currently outstanding in the catastrophe bond market and insured by capital markets investors. To date in 2023, I think there's been 11 billion of new issuance, so already exceeded the amount in 2022. So a huge market, and where sponsors are issuing bonds or sponsoring bonds to avail of sort of additional protection that can be provided from catastrophe bond investors. What's the investor base in the catastrophe bond market? I mean, a lot of it is dedicated insurance-linked securities funds. About 46%, I think, of the investor base of of the transactions that we bring to the market. 46% of those are bought by these dedicated insurance-linked securities funds. You might have heard of 12 Capital and Schroders and Fermat. They're based in the US, in Europe, Bermuda, dedicated funds. And we also see, and because these are very specialized bonds, so you don't normally see your usual institutional investors invest directly in catastrophe bonds, but they may invest through sort of alternative investments with ILS dedicated funds. We also see insurance and reinsurance companies purchasing our catastrophe bonds. That includes the likes of Swiss Re, Munich Re, SCOR. So lots of reinsurance companies, some of them in Ireland, buy into our catastrophe bonds. And then other sort of general asset managers and family offices and even pension funds are sort of buying our catastrophe bonds. The market generally, I mean, the market as a whole is actually the main sponsors of catastrophe bonds are insurance and reinsurance companies. And the main exposure is in the US to US hurricane and earthquake risk. You can see this in the chart on the right-hand side, where I think it's about 70% of the issuance in the first half of this year was covering risks in the US earthquake and US hurricane. Most of that is insurance companies in the US, a lot of it Florida hurricane risk, transferring some of that risk to capital markets investors. And then there's a portion of it that is the transactions that we bring to the market, which are diversifying risks from earthquakes and hurricanes in the likes of Jamaica and Mexico and Chile, and other corporate sponsors as well, right, in the market. Most of it, how it differs from insurance in a way, from generally, and some of you probably know this better than me, catastrophe insurance is written on a 1-year basis. Most catastrophe bonds are written on a 3-year basis. I think for this year, so far, about 73% of that 10 billion that was written was on a 3-year basis, and some of it 4-year, some of it 5-year, and some smaller than that. And then again, because most of the sponsors in the market are insurance and reinsurance company, the risk is written on an indemnity basis, where insurance and reinsurance companies are indemnifying the books of business that they've written, so covering the losses on their actual portfolios, whereas the transactions that we bring to the market, and sometimes corporate bring to the market, use what we call parametric triggers, where the payouts are based on the physical parameters of an event, where you're not necessarily trying to cover the actual losses incurred, but where you're trying to, in the instance of the bonds that we bring to market, to cover the risks and provide governments with quick payouts when a disaster happens. So as I said, we are in this market since about 2007 in the catastrophe insurance market. We issued our first catastrophe bond in 2014. That was for the Caribbean Catastrophe Risk Insurance Facility, covering earthquake and hurricane risk in a range of Caribbean countries. And since then, we have transferred about 6 billion of risk from emerging markets to insurance and capital markets. About 4 billion of that has been through catastrophe bond transactions. A lot of it, or most of it, in Latin America, for Mexico, for Chile, for Jamaica, Peru, Colombia, and the Caribbean. We did a transaction for the Philippines, where we brought Philippines risk first to the insurance market for 2 years in 2017 and 2018. And then in cat bond format in 2019, it was a 3-year transaction. We also did, I think I mentioned at the start, a transaction in 2017 where we brought pandemic risk across countries that were low-income countries to capital markets investors for the first time. So a whole host of experience. Most of it has been earthquake and hurricane. As I said, we did do a pandemic risk. It's been sort of that 4 billion of risk that we've brought to cat bond investors. It's been 9 cat bond transactions, but 25 individual cat bonds. But why do we do this? I mean, I mentioned at the start the World Bank's mission is to end poverty, reduce poverty, and increase shared prosperity. Part of that, obviously, we help governments finance their sustainable development activities and projects. And ultimately, if disasters hit these countries, it can put those development sort of success backwards and slow down or undo some of the development gains and successes that they've had. I mean, the impact of disasters on low and middle income countries is significantly higher than it is on higher income countries when you look at the impact in terms of the impact on GDP. So we really work with these countries to help them have financing in place ahead of a disaster happening, so that they don't have to sort of divert funds away from other sort of much needed development projects. The transactions that we do, they're not designed to cover all of the costs that countries may incur, because they may run into the billions, but they're designed to really provide countries with access to immediate funds when a disaster happens, so that they can finance their relief and recovery efforts. What that means is they can respond quickly, because there are studies out there that show that if response is delayed, the overall cost of a disaster can be magnified by 3 to 5 times what it would be had the response been quicker. Again, not designed to cover all of the costs, but to provide a quick payout. And we do that by structuring the transactions with parametric triggers, where the payouts are based on physical parameters of event. That might be the magnitude of an earthquake, the intensity of a hurricane. And because those are things that can be sort of known within sort of the days or weeks of an event, we can provide a payout within days or weeks of an event, rather than having to wait months or years for claims assessments to be done on the ground. So I'm going to touch on one transaction that we did recently. This was for the government of Chile. Chile is one of the highly exposed countries to earthquakes. They have a huge exposure risk to earthquakes occurring. And earthquakes, if a severe earthquake happens, it can have a huge economic loss for Chile. We did, back in 2018, we did a large transaction for 4 countries in the Pacific Alliance, where Chile was one of those countries that had sponsored a catastrophe bond that provided them with 500 million of coverage back in 2018. That coverage expired in 2021, and they wanted to renew it. I mean, they were still sort of in their responding to COVID in 2021, so that renewal got delayed and set back a little bit. But ultimately, they wanted to come back to the market to renew that coverage and also to expand it. And this is really just one part of their broader sort of risk financing strategy that they have to help them respond and be sort of financially protected from earthquake events. So they had this big objective of increasing the coverage. So 500 million was already a large amount of risk to be placing in the market. And we started working with them in the latter part of last year, so latter part of 2022. And for those of you who are familiar with the catastrophe bond market, and even from the reinsurance market, you'll know that this was a very difficult time. There were capacity constraints within the ILS market, where new funds weren't necessarily flowing into the market because of investors rebalancing portfolios because of losses on other asset classes. There was a nervousness from investors because of the inflation risk on claims. And in the broader sort of reinsurance market and the ILS market, we were seeing sort of this harder market, higher pricing, where investors were looking to recoup losses from previous years. with higher pricing. So with all of those sort of liquidity constraints and higher pricing and the overall objectives of Chile to sort of increase the amount of risk that they wanted to have insured, we decided to use this very unique sort of dual placement strategy where we would simultaneously market the risk and place the risk both in the reinsurance market and in the cat bond market at the same time. And that allowed us to both increase size for Chile and to get the best pricing that was possible for Chile by sort of using both markets at the same time. It ultimately resulted in 630 million of earthquake insurance for the government of Chile, 350 million through a catastrophe bond, and 280 million through catastrophe swaps with 4 reinsurance companies. This is a transaction that provides them with earthquake insurance for 3 years on a parametric basis, where if an earthquake happens, the payouts are determined based on the magnitude, the depth, and the location of an earthquake. And it really is to cover their most extreme events. So events that have a 1% expected loss is the overall transaction. So the probability of an event occurring that would trigger a payout is about 1.5%. So really you're capturing those most extreme events that have a huge impact or economic impact on Chile if they do occur. This was a higher interest rate environment, a higher pricing environment for Chile. So the risk margin that investors would earn for that 1% expected loss is 4.75% is where it eventually came in. The same on both on the reinsurance, on those catastrophe swaps, which are effectively look like a reinsurance transaction, and the catastrophe bond, investors in both earn a 4.75% per annum for that 1% expected loss. Some of the other objectives that Chile had were around refining the structure and capturing tsunamis, and I'll cover those in a moment when I get to that. I mean, this is what the sort of structure of the transaction looks like. And for those that are familiar with catastrophe bond and those that aren't, generally in the catastrophe bond market for catastrophe bonds that aren't issued by the World Bank, the usual route is that a sponsor, whether it be an insurance company, a corporate, they would enter into an insurance agreement with a special purpose vehicle, and that special purpose vehicle would be the issuer of the catastrophe bonds. And then they would hold the proceeds of that bond in a collateral trust in very safe AAA paper, a lot of time US treasuries, until such time as maybe they're needed to make a payout. So these are funded transactions, unlike reinsurance transactions. We have a very unique platform at the World Bank under our Capital at Risk Notes program, where we are the issuer of the catastrophe bond. Because we're already a AAA rated entity, there's no requirement for us, or no need for us to set up an SPV or to hold those assets in some other in US treasuries, because already we're AAA paper. So that is a very nice vehicle for our the governments who are members of the World Bank to be able to access the insurance capacity of the capital markets through an entity that they are a member of, and get their insurance ultimately from a AAA rated entity of the World Bank. So the government of Chile, what they do is they enter into an insurance agreement with the World Bank, where they agree to pay us the risk margin, in this case, the 4.75% on that 630 million per annum. And in return, if a triggering event occurs, the bank will make a payout to Chile when those events occur, if and when those events occur in the future. The bank, we don't retain any of that insurance risk on our balance sheet. We pass all of it either to the insurance, reinsurance market, or to the catastrophe bond market. So in this case for Chile, we did it, as I said, in a dual placement, where we issued a catastrophe bond. It was a $350 million catastrophe bond, where the investors deposit that 350 million with us. And that 350 million, like our outcome bonds, it's used to support our sustainable development activities and programs. Unless if and when there's a payout, then that bond principal would be reduced, so that we can make that payout to Chile. And in return, what the investors receive is they receive obviously the 4.75% that we receive from Chile, and on top of that, they receive what we would ordinarily pay on a World Bank bond, so our funding cost. At maturity, if there have been no events that have triggered a payout, then the bond investors get the return of principal from the World Bank, or if there has been a payout, whatever amount is remaining out of that 350 million gets returned to the bond investors. Simultaneously, we entered into catastrophe swaps, look just like reinsurance agreements with 4 reinsurance companies that amounted to a total of 280 million. So that is unfunded coverage from the bank, where again, we pass the premium payments that we receive from Chile to those reinsurance companies. And if and when there's an event, an earthquake event that would trigger a payout, we receive a payout from those reinsurance companies, and then we pass that payout on to the government of Chile. We, for Chile, retain the credit risk. So if there was a delay for any reason or a missed payment from those reinsurance companies, we are still the reinsurance provider to Chile, and we still guarantee that those payouts to Chile. So that's what the structure looks like for Chile. In terms of the parametric trigger structure, I mean, I talked about the payouts being determined based on the magnitude and depth and location of an earthquake. And what we use is we use a structure called a cat in a grid. And effectively what that means, you'll see this on the left-hand side. And basically we take the geographic area of Chile, and that is covered with a grid of boxes. And within each box, the magnitude and depth of an earthquake that would trigger a payout is defined for each individual box. The reason it's defined for each individual box rather than for the entire, say, geographic area of Chile is obviously you have areas that have higher exposures, and you want to capture, you know, events that maybe, if you have an event, Santiago, for those of you who've been to Chile, is the capital, and there are obviously high asset exposures, and if an earthquake that maybe is a magnitude 7.5 were to happen in Santiago, that would have a much bigger impact than if that same 7.5 magnitude earthquake were to occur in some other region of Chile that doesn't have high exposure. So really we work with a risk modeling firm and Chile to come up with a structure that optimizes the coverage for Chile, and also is sort of something that we think will be acceptable to investors. What that looked like for Chile, there was 290 boxes of differing sizes, so smaller boxes around the areas with key exposures in Santiago. And then within each box, we actually define 3 different sort of magnitude thresholds, where you could get a 30% payout if the event exceeds, and I'm showing this with just an example of one of the boxes. So if we take one box, there was if an earthquake that occurs in that box, which has defined the geographic coordinates, there would be, if an event that's a magnitude 7.6 event happens, there would be a 30% payout. If it's a 7.7 event, there'd be a 70% payout, and if it exceeds a magnitude 7.8, 100% payout. So structured like this, so very transparent for Chile, that they know exactly if an event occurs, what is the payout amount that they can expect, and very easy for them to explain to the government and to everybody what the coverage is that they've purchased. In terms of, I'm just going to cover this quickly for Chile. What we also show them is, based on historical events, what are the type of events that would have triggered payouts, and that makes them be able to really understand what is the coverage that they're purchasing. And also we show a whole host of information to investors around that 1% expected loss. What is it made up of? What are the type of events that are being picked up, and in what different areas, and a whole host of information to investors that goes into sort of the risk analysis that's presented to investors when we're marketing these bonds, that I won't get into today. In terms of the investor base for that Chile transaction, the investor base is spread across Europe and North America, very small bit in Bermuda and Asia. And again, mainly dedicated insurance-linked securities funds, with some of it coming from the insurance and reinsurance and other pension funds and asset management firms. And again, that was as well as on top of the sort of the 280 million that we had directly with reinsurance companies and insurance companies on our catastrophe swaps. So just to sort of finish up on catastrophe bonds, and our role in the catastrophe bond market, and why investors we think are interested in this asset class. I mean, as a whole, catastrophe bonds really are uncorrelated with other asset classes. If there's a global market crash, that's not going to cause an earthquake or a hurricane. So really, we think that these catastrophe bonds, not just ours, but cat bonds generally in the market, they show robust performance both in good and in bad times. And in a volatile investment world, slow and steady returns for investors can be quite attractive. And also, if there is poor performance, that can often be self-correcting. And we see that in this higher sort of pricing environment where investors can look to recoup some of their losses from previous years. In terms of sort of our participation in the market, we are originating diversifying risks for investors that might otherwise never get to the cat bond market. I showed you most of the risk comes from US earthquake and hurricane, and all of the risks that we bring really are diversifying risk, where we're bringing Chilean earthquake, hurricane risk from Jamaica, pandemic risk in the past. And that is nice for investors because it's a diversification from their other risks that they would have. As I said, all of the risks that we originate and we insure, we fully pass all of that to the private sector. And we also work very much with external partners in the private sector to both design, structure, market and issue these transactions, from risk modeling firms to working with structuring agents and brokers and law firms in the space. I mean, for our clients, we think this is a really valuable solution for them to be able to easily access the risk-bearing capacity of reinsurance capital and capital markets from an entity that they know and they trust, where we will coordinate the entire transaction process for them. And we think because of our experience and track record in both the cat bond market and the capital markets more generally, that our transactions generate really good demand in terms of they are always oversubscribed with competitive pricing. And we see this in our transactions where they price sort of below the market line across the board. So key takeaways. I mean, this was not intended to be a sales pitch. If it was some of that, and some of you are interested in our outcome bond and our catastrophe bonds, that is a great success for me. It wasn't intended to be that. I hope this has been an education exercise and been interesting. Key takeaways that I hope you might take away from this is that, I mean, World Bank bonds are rated AAA. We issue in a range of currencies and maturities, but ultimately we are a great vehicle to allow investors to support sustainable development projects globally. Where I sit, we are really focused on this new sort of innovative outcome bond investments, where we are able to provide investors with direct exposure to projects in developing countries that have positive social and development outcomes, where investors can invest in those projects through the very safe environment of a World Bank bond, where they're guaranteed a return of principal, but also have the potential to earn a yield pickup compared to a regular sort of risk-free World Bank bond. On the catastrophe bond space, we are very lucky to support some of our countries and members who are extremely exposed to disasters, and then to bring that risk from those sort of diversifying risks to the catastrophe bond market. Not only are they diversifying risks, but unlike other catastrophe bonds in the market, they're not subject to inflation risk or the risk of trapped capital like other catastrophe bonds can be. As I said, where I sit and the bank more generally, we are being asked to do more by the global community, and some of that will come from us replicating and scaling up these outcome bond transactions to support more projects globally. And on the catastrophe bond side as well, we want to, increase and scale that business to better support our clients to be able to respond to disasters in the future. I hope that's been interesting. Let me stop there and back to you for questions. Dara, I hope I've left enough time for some questions.
Thanks very much, Naomi. There's actually quite a few questions to get through. I might just sneak in one of my own first, if that's okay. There's a tradable market in World Bank bonds and a minimum issuance size if a pension fund wish to buy into it.
Yeah, there is. There's very much. I mean, all our bonds are traded in the secondary market, even our catastrophe bonds. And the outcome bond is a little bit more unique, where they might be a little bit more difficult to trade in the secondary, but certainly all of our plain vanilla bonds are in the secondary market and our catastrophe bonds.
Okay, thank you. And then
and generally, I mean, again, this is a little bit outside of my area of expertise on our plain vanilla bonds, but certainly for some of these more complicated bond structures, the minimum size tends to be around 100K of investment, because these are complicated transactions, and we want to make sure the investors who are buying them are sufficiently able to take those risks.
Yeah, thank you. And so a general question, what does the World Bank do to manage its reputational risk? For example, if any of these early novel bonds disappoint, then future projects will potentially fail. Presumably the World Bank is very choosy at present. For a time, could be expected to either pool project risks and or set up bonds for less certain projects? Because is the World Bank very choosy in terms of other finances?
I mean, we are in the Rhino bond case. The project was a World Bank project, so that project was being implemented and overseen by the World Bank. So there's a whole host of a huge governance and accountability framework that sits around those projects that helps us to manage any risks with that project. The Vietnam case was a little bit different because it was a project that wasn't being implemented by the World Bank. We're not taking any risk in that project, but at the same time, you're absolutely right. There's reputational risk for the bank with being associated with it. So we needed to get comfortable with the project risks, that the project developer had a good track record and experience, that there was no red flags in the project, anything that we saw that could potentially cause damage in Vietnam or to any of the schools. So we manage a bit of that. We also, I mean, on the investor side, there's a huge amount of risk disclosures in the bond documents, where we disclose all of the risks that are involved for investor, particularly in these very unique transactions where they're not taking risk on their principal, but they're taking risk on their return, that the return is dependent on these risks or on this project, and that project is exposed to these risks. So that is all very much disclosed to investors.
Good, thank you. And Emmett Leahy says, "Hi, Amy, great presentation. Wondering, do countries typically renew after 3 years? And assuming that's the case, do higher interest rates pose a significant risk or issue to the country in question?"
So Mexico is the best example, right? Mexico have been in the cat bond market since about 2006, and they have renewed their coverage more or less every time it's expired. And we expect, I mean, their current catastrophe bond is due to mature next March, and hopefully they will come back to the market. Again, they have always done so. I mean, Chile is a good example, right? When they issued in 2018, it was very much a lower interest rate environment, a lower pricing environment. But ultimately, they see this coverage as being part of their broader disaster risk management strategy. And they wanted to renew that coverage when it expired. They weren't able to do so because of other constraints with COVID and everything else. But they did ultimately come back to the market at a much higher pricing environment and even increase the coverage even in that higher pricing environment. I mean, generally, it is difficult for a lot of the countries that we work with. The cost of these transactions is huge. If you look at the numbers for Chile, that's 630 million coverage at a 4.75%. It's about 30 million of premiums annually. So it is difficult. So we also look to donors to support countries with these transactions. And Jamaica was another catastrophe bond that we did, where actually a donor, so the UK, Germany, and the US came in and funded those premium payments for Jamaica.
Good. Thank you. And I just probably we're almost at time, but I'll just ask maybe two or three final questions, if that's okay, Amy.
Yeah, sure.
Okay, thank you very much. John Armstrong, Amy, as someone working on healthcare financing options, sometimes for the World Bank, are you aware of any recent health-related financing arrangements, such as pandemic risk, that have been in place? I've seen it from time to time in microinsurance markets, though not from the bank.
Yeah, good question. I mean, when we obviously, I mentioned the pandemic bond that we did in 2017, and that ultimately had a payout when COVID happened. I mean, we're not looking right now at bringing another pandemic transaction to the market. That's not to say that we won't in the future. And we do we have had countries reach out to us and ask about that pandemic transaction, where ultimately we were insuring pandemic risk or the risk of pandemics. And that was similar to Chile, where we did it both on reinsurance and catastrophe bond format, where we brought those risks to the pandemic risk market. So there are some countries looking at it. We have, certainly where I sit, I haven't seen it at the micro level, but that's not to say that there aren't folks in the bank. And John, very happy to follow up and hear about what you're doing with the World Bank.
Great, thanks. And then Aaron Nolan has asked on outcome bonds, where do project proposals usually originate? Is it project developers or banks, such as Citibank in the case of the carbon bond? Or does the World Bank actively seek out opportunities? Or do many proposals come to the World Bank and not come to Patricia?
Yeah, I mean, great question. And there was a lot of visibility of if you Google now Rhino bond, you'll find so many articles about it. It generated huge interest and public interest. And similarly with the carbon bond, a lot of visibility around those. And those have generated interest in using this structure again. So that has where we have a number of different transactions in the pipeline that will use sort of potentially have a similar structure. They have come to us from a variety of sources. Sometimes investment banks come to us with ideas. Sometimes we have project developers come directly to us with, looking to see if we can support their project using this structure. We also have internal banks and the internal teams within the World Bank where we would love to be able to support their projects that maybe they're already financing some activity, but that activity could use some additional financing, and we can generate or mobilize that using this structure. We also have donors who maybe want to support projects but don't want to take the project risk. Obviously, donors' funds are limited, so if they can pass some of that project risk to investors, we sometimes hear from donors who are interested in using this sort of vehicle to finance sort of just a pace for success model. And so it's kind of a range of, we are seeing it all at the moment: project developers, investment banks, donors, internal teams in the bank.
Okay, thank you. And I think Joseph Kennedy said, are climate change concerns having any impact on investor appetite for hurricane bonds? And nice to see you, Naomi.
Yeah, nice to see you, Joe. Joe and I did a bit of work together for a few years when I joined the bank first. So nice to see you online, Joe. I mean, we certainly are not seeing any reducing interest because of climate change in these catastrophe bonds. Certainly we don't see it. I mean, the market, as you see, is growing and continues to grow, and the volume of deals is growing. Obviously, we're in a bit of a higher pricing environment. So that's bringing higher prices for our clients. It's a bit difficult. But no, I don't think we're seeing any reducing interest because of climate change. If anything, on our side, what we're seeing is more of a need for these types of, transferring some of these risks to insurance and capital markets.
Okay, thank you. And it's like a different question. Mary Hall is, thank you very much for your presentation. She lectures in DCU and has asked, actually, does the World Bank offer paid internships for students? So could a DCU student do their 6-month work placement in the World Bank?
Yeah, lovely for you to raise that, Mary, because I did actually have it in my notes somewhere to mention it. I mean, we have in Treasury, we have an amazing internship program where every year we hire, I think it's about 20 interns for the summer. And then we take about half of those back on a 2-year junior analyst program the following year. So students that are in their 3rd year of university, so anybody who's in their 3rd year of university now should be applying for this program for next summer. It's an incredibly competitive program to get into. We haven't had anybody from Ireland, so I would love to see somebody from Ireland apply to it. And if somebody is applying, let me know. So if you have kids or people you know who are studying, who might be interested in development and interested in this space, I mean, it's a great program. That's Treasury. I mean, that's where I sit. There is other internship programs in other parts of the bank. And you can find a lot of the information, I guess, on the World Bank website, if people are interested in that.
Yeah, thank you, Naomi. I think it'd be an extremely interesting internship for any lucky student who might be successful. I think there's a number of thank yous as well. I'll give from Damien Fadden just to say thank you. Interesting presentation. And then for myself, I think that was a really, really interesting presentation. I think the it was like extremely enjoyable, and you must be hoarse after speaking for so long. But thank you. It's very, very enjoyable to watch, and thanks for. I think I learned a lot from it myself.
Not at all. It's been great. And I mean, if anybody has questions, I don't think I pulled up my my email address, but feel free to reach out. You can find me on LinkedIn, or Dara can share my email address. I'm not a member of the society these days. Maybe I'll rejoin at some point. But it was great. I mean, this is a pleasure for me to do. As I said, it's been 9 years since I've been at a society event. So nice to do this, and I hope it's been interesting for everybody.
Okay, I think speak for everyone says it was extremely interesting. We're extremely grateful. Okay,
Super.
I think that there's no more questions. I'll call the presentation into a close. Thanks, thanks
Brilliant.
everyone.
Thanks everybody. Bye bye.